All right, me and my boy, Dave Ramsey, agree on quite a few different things. However, I disagree with a lot of things that he says about that there's no place for permanent life insurance. If you follow my channel for any amount of time, you'll know that I have a saying that I say quite often, and that is only the Sith deal in absolutes. That's from Star Wars. If you haven't seen it, you had a terrible childhood, and I am sorry for you. However, in today's video, we're going to be reacting to one of Dave Ramsey's videos, specifically why he hates whole life insurance, and I'm going to give my breakdown coming from the opinion of someone who actually doesn't really like whole life insurance and believes term life insurance is probably the best option for the majority of Canadians. However, I'm going to try and give this the most unbiased opinion and objective view that I can. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting to you, I'll drop a link in the description below and you can check it out, pardon me. But with that, let's just get right into the video. These guys basically just have the same show that I have. I mean, they're just reacting. They just react live to people that are calling in, and they just got their little cronies on the side. I like this.
What's up?
Nothing. Quick question. First of all, I just wanted to preface it by saying, Dave, I've been listening to your show for a while, and I really want to thank you for all your advice. I used to be one of those people that really just thought about, well, yeah, I can afford that payment. I can afford that payment, and just all of a sudden, I'm just under this massive amount of debt. And after listening to you for a couple of months, I've just basically restructured the way I do everything. I'm just, stop buying stuff. I'm getting my debts paid off. Within a couple of years, I plan to be completely debt free. So, thank you very much for your advice. My question is, I've heard you talk a little bit about.
Which I just want to quickly stop here and note, I actually really enjoy this about Dave Ramsey. The fact that he focuses on proper financial planning and paying down high interest credit card debt, high interest debt that you're carrying, not overextending yourself. Like, I believe in all those things. Like, those are really good things to do. Debt will just eat you up and kill you financially. And the fact that he focuses on it is really good because, I mean, it's not product focused. It's just education focused. And I appreciate that.
Whole life policies. Now, my wife and I right now have whole life policies. They're good until we're 125 years old. We have about $1.5 million in coverage. Costs us about $680 a month to have that. And I've heard you sort of say that you didn't think they were a great investment, but I haven't really heard you get into any details about why you think that is. So I was wondering if you could...
By the way, I haven't seen this video before, so this is all live reactions.
Just talk about that a little bit, and maybe I'm missing something.
And sorry to keep stopping the video. I actually have another video on my channel called Is Permanent Life Insurance a Good Investment? And I really break down like the apples to apples comparison. It's like a 45-minute video where I went through all the numbers and I compared it to in Canada where you have traditional like RRSPs. In the States, I'm not sure exactly what it is, like 401ks and Rothschild and IRAs, things like that. But in Canada, we have RRSPs. And I compare it apples to apples, just like here's invest in life insurance, here's an RRSP. By the way, if you guys are interested in that video, just drop a comment below saying, send me the invest in life insurance video, or it's somewhere on my channel. And it gives a really good comparison of like how this type of strategy holds up compared to other traditional investments. And like, I won't be a cliff. I'll tell you guys right straight up, it doesn't do that well. However, the one variable is tax. The higher the tax rate, the more efficient a invest in life insurance strategy becomes.
And if I am, I'm sure you'll hit the point.
Okay, sure. Well, the overarching main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x.
Yeah, he's not wrong on this. I mean, but you're not really comparing apples to apples, right? Because term life insurance will expire. It's a very good product, by the way, and I sell a ton of term life insurance, but you're not really comparing apples. Yes, it's 20 times more expensive to get a whole life, although there's different reasons that you get a whole life. Side note, Dave's got a great voice. Like, he's got a good camera voice. It's very like, methodical, and I'm talking like this, and this is some things. It makes you want to listen to him. I don't know if I have that kind of voice. I probably don't, but I just want to listen to whatever he says. It sounds true. Everything that he says sounds true. I just want to listen to him.
Okay. And for the insurance, obviously, whole life, though, has another component to it that term does not have.
All right,
You're obviously
talking about
aware
it.
of that. You spend a lot of money on this. And that other component is a cash value buildup. Now, the cash value buildup is the other $95 out of $100 approximately. Could be $91, could be whatever, but it's somewhere in that range. Nationally, across the top 10 whole life insurance companies, it is $95. Okay, so $95 going into cash value, $5 purchases the same amount of insurance, life insurance. Now, so then the gripe that those of us have that hate whole life insurance, and it's not a mild dislike, I hate it, is that what happens to that $95?
Good for him.
And in cash value, what you will do, and you're well past this, but if you went back and looked at your policy pages, your cash value buildup for the first 3 years, your savings buildup is zero. 100.
So, I want to touch on this real quick. There's a lot of different ways that you can structure a whole life policy, okay? And so, like, the easiest way that I explain this to clients is imagine there's this graph, okay? And on one side of this graph is max death benefit and then lower cash surrender value. So this is over here. And this is like one way you can structure a whole life insurance policy where, yes, in the early years, you have no cash surrender value. On the other end of the spectrum over here, you have a lower death benefit, however, a much higher cash surrender value. And you can structure your policy anywhere in this spectrum, right? So you can structure it a number of different ways to dump as much into cash value as you want, or maybe you're more focused on the death benefit or somewhere in between or right over here or right over here. And so to, make a blanket statement that like you have nothing in the beginning is totally false. Because I mean, here in Canada, we can do a lot of interesting things where you do like a wealth accumulator. So you put more into the whole, or to the cash surrender value, what's also known as max EDO, which is like additional deposits. So you're essentially putting as much into the cash surrender value as you can. And then you can also buy term life insurance riders that you put onto the whole life, which then increases how much you can put, your contribution limit that you can put into this. So you can dump a ton of cash into this type of strategy or type of policy. And that all goes into the cash surrender value. And you have massive cash surrender values and you break even at like year 3 or year 4 if it's structured a certain way. However, you do lose out on a lot of that death benefit. So there's different ways that you can structure it. So to make a blanket statement that you get nothing the first few years is false. However, I mean, most advisors will just sell you a crap product, right? I mean, like a lot of them are just selling that. So it's not totally out to lunch, but I mean, he's not a life insurance advisor. He doesn't understand, like he's not licensed. He doesn't understand how it works. He has a general idea, but he's never actually crunched the numbers. Because if he would have crunched the numbers, he would see that there actually is some unique scenarios where it does work for high income earners. So he obviously, it does. He's never broken down the numbers. He's never actually taken the time to look at it because like I'm an analytical guy. I'm a mathematics guy. I just look at the numbers. The numbers make sense for some people. It's logic, right? Like, so anyways.
Percent of the $95 goes to fees. It's front loaded as an investment, which
unless you structure it like I just told you about.
In and of itself is not necessarily evil. It's just frowned upon in the financial planning world by and large. The second thing is...
Side note, I need a hype man. See this guy on the left here? I need a hype man. This guy's just like, yeah, Dave, you got this. I need to have myself a hype man that just stays with me and sits with me somewhere and hangs out. And he's like my hype man. I'm looking for hype. If anyone wants to be a hype man, let me know.
That once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%. Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig.
You can't compare this apples to apples and say, like, here's what it is from a cash surrender point of view, and it's only 1.2 or 2.2 or 5 or whatever it is, right? Because there's more variables to consider in that. Like, two of the biggest things that make a whole life policy or whole life strategy as an investment viable is, number one, the tax efficiency. So everything that you accrue within your cash surrender value account, granted that it's within these certain limits, is tax exempt. And so for someone making 40, 50 grand a year, well, that doesn't really matter that much. However, for someone that makes $100, $150, $200,000 a year and their marginal tax rate is like 40, 50%, that's huge because you're essentially making double had you put it into a non-registered account and it was taxed. So that's the first variable that you need to consider. The second variable that you need to consider is a lot of these strategies where people pitch using whole life insurance as an investment, they will pitch it as you should build your cash surrender value. You should then leverage against it, borrow the money out, put it into another investment or another business or buy some real estate property. Then you get tax deductions from the interest, as well as you get to double dip essentially and put money into this investment account or this whatever it is that's growing, and then your whole life is unaffected and it still continues to grow as well. So to just purely do this on a percentage basis, it's really hard to compare apples to apples. And again, if you watch that video that I made on the channel, investing in life insurance, I did a pretty darn good job of comparing it apples to apples, and you'll see that it's not like 1 or 2%. You'll see it's more like 5 or 6% if you actually break down all the other variables, and he's just kind of failing to do that.
But not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes. And so it's a horrible rate of return on a long-term investment. And those two things are bad, but the stake in the heart of whole life, and the reason the entire financial planning community that are not in the whole life insurance business have abandoned whole life. No one sells this but whole life insurance agents. No.
What? I mean, it's kind of I don't understand what he's trying to say. Is no one sells life insurance except for people that are licensed to sell life insurance? Well, of course. Like, what kind of... That's like saying nobody sells mutual funds except for people that are licensed to sell mutual funds. I don't understand his point.
No one sells it anymore.
No hype man. I need a hype
traditional financial planner, no SmartVestor Pro, no one in the financial world sells it. The only people that sell it are whole life agents. They've gone away from it. And
I mean, yeah, it's just false. It's false, guys. Like, I'm sorry. Yeah, I mean, listen, rich people are absolutely using this. Yes, life insurance people are the ones to start the conversation. It's an incredibly complicated product and strategy that when used effectively when used correctly, is incredibly effective. However, you still need to sell it. Like, it's like anything else. Like, even a financial planner still has to sell his financial planning, services. Like, everyone still needs to sell themselves. And so like 99.99999% of the time, people that are incentivized to try and explain these complex strategies to business owners are compensated for it, right? Like, that's just logic. You know what I mean? Like, no one's going to try and explain and sell an incredibly complicated yet effective strategy if they make no money from it. Does that make sense? Right? Like, why would any financial planner that's, selling $1,500 financial plans or $2,000 financial plans, why would he go through the extra like 10 or 15 hours that it would take to not only build this type of strategy, but then effectively communicate it to the business owner and the accountant and the tax lawyer so it's done correctly, and he gets zero out of it, right? Like, that doesn't make sense. But I mean, no, there are very wealthy people that do this. And accountants, usually, if you're a really good accountant, like a high net worth estate planning accountant and tax lawyer, they understand this stuff. And like, in my previous business where I did a lot of this work with business owners, I got tons of referrals from tax and estate planning lawyers and really competent accountants. And they could understand this stuff and position it with their clients, and they could use it quite effectively. So to say that no one's using it except for insurance advisors is just a flat out lie.
This is the reason. Once you've paid the extra $95 to build up, and on your $680 premium, you said you had a $1.something million policy?
Okay, and real quick, this will be my last interruption for a while, I promise. Although in this guy's scenario, it sounds like he shouldn't have it, right? Like, I don't know the specifics, but like, most of my clients that have this type of strategy implemented are doing like minimum $40,000 to $50,000 a year in premium. So you got to think these are businesses doing $5 million in revenue for the year. They have additional cash. Their RRSP is maximized. Their TFSA is maximized. They're looking for additional strategies. They're already taking 150, 200,000 out of their corporation as a salary. Their tax rate, their marginal tax rate is incredibly high. So, I mean, this guy, it sounds like, him and his wife, they're doing $600 a month. So what is that? Like $5 or $6 grand a year or something like that. That's like a tenth of the minimum size that I personally do.
I've got $1 million. My wife has $500,000, and that's our combined premium is $680.
Okay, yeah. So $1.5 million. If you die, your wife, the beneficiary, I assume, would get $1 million. That's your face.
My daughter. It doesn't matter.
Okay.
But yes.
Yeah,
correct.
whoever the beneficiary is going to get the $1 million.
Right.
That's what they're going to get. That's all.
Right.
If you have a cash value of $200,000 at 2.4%, that you put $95 per hundred in to get to 200,000 or to get to 100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing. After that, it pays 2.4%, and when you die, they keep your money.
All right.
Which makes it absolutely horrendous. So you're much better off. And many, many decades ago, the financial planning community, by and large, started moving towards buying term life insurance for the $5 per hundred and doing almost anything else with the 95, but over in the investment world, away from the insurance world.
I mean, I agree. I actually agree with this. I have a video on my channel, Buy Term Invest, The Difference. I agree with this principle. However, for the high income earners and business owners, it could be an applicable strategy. For the majority of Canadians and Americans, absolutely, this is not a great strategy. However, for some people, it can be effectively used. Only the Sith deal in absolutes.
Put it in a freaking fruit jar. At least it's there when you die.
Okay, so you said, would your advice be to just terminate
term
those
wouldn't be there when you
and
die.
And do what you suggested, purchase relatively inexpensive term life policies, and then put additional money. I mean, I do have investments. I mean, I could just up those investments. I invest into mostly directly in the S&P 500. I've got a 401k.
Exactly.
So would you?
But get the term life in place first.
Yeah, exactly. Get your term in place first. Never cancel life insurance until you've got new in place, because we don't.
100%. That's very true.
You have the proverbial milk truck or bus in the middle.
Okay.
Between the two.
So just look at the money I've been spending over the last 5-10 years. Is just write that off and just start.
It'll make you want to throw up.
Yeah.
But yes.
But that's the case. Now you will get your cash value out by canceling the policies, whatever it is.
Okay.
It doesn't die then. But you never get both.
I understand.
You never get the insurance and the investments.
That's false. I mean, there's different ways that you can structure it where you get the cash value, plus paid up additions increases the face value over time. Plus cash value you can think about as an advance on your money if you wanted it, as a death benefit. I mean, again, there's a million different ways that you can structure it. And guy, you see what I'm saying though? You see what I'm saying? Don't get me wrong. I really like Dave Ramsey. He says a lot of good things. However, he deals in absolutes. He says, this is how it is all the time. This is shit all the time. This is it. It's like, well, no, actually research how the product works. There's a time and place for almost everything out there. So to put a blatant, it's just, you're lazy. You're lazy. That's it. You're lazy. You don't want to figure out exactly how it works and where it could be applicable. Like, what do you think? Like, honestly, think about it. Trillions of dollars goes into the insurance industry. And you think that all of those people are suckers and it didn't make sense? Like tax and estate planning lawyers, accountants, all these like advanced high net worth estate planning people, all of these people are just deceived by insurance advisors and it never makes sense and it would always be better to just put it into the stock market? Like, think about it logically. Obviously, somewhere along the line, it makes sense. Like, you know what I mean? Like, it doesn't take that long to start seeing some flaws. You think everyone out here is fooled and Dave is the only one who knows that it's a scam across the board no matter what? There's no place for it applicable ever?
And you're always paying for both. And that's the consumer advocate like us, our reason for hating on these things and just saying they're absolutely horrible. It's an antiquated product from the 40s and 50s that built large buildings in the skylines of almost every city, and that everyone now has pretty well moved away from, except the companies with their name on that kind of stuff. So,
God, I'd love to do a debate with Dave. I would love to do a debate with Dave. Dave, if you ever watch this, I would love to do a debate with you. We could just look at your numbers, guy. Let's look at the numbers.
One last part of this discussion that's worth having.
Sure.
Because you're obviously doing well financially, and you're doing really good with your analytics on this. The last thing that happens is the irony is that we really don't necessarily need life insurance for our whole life.
Right.
So if you've got $2 or $3 million in your investments and zero debt, and the kids are grown and gone, and you die, well, I think your wife will be okay.
I was looking at it as like, I can die broke if I want to, and at least they'll have this much. But you're right in the sense that I won't be able to spend all my money.
Yeah, but if you put the $95 in a fruit jar, you wouldn't die broke.
Right, exactly, right. Okay, I'm doing it. Thank you, Dave.
Hey, man, thanks for the call.
Wow.
Yeah, so he does bring up a good point. Like, there is a certain point where you can become self-insured for let's talk term, and let's talk permanent. Okay, so during your lifetime, a term life insurance product, like if you're relatively young and you're also very wealthy, I mean, it can just make sense to get a term life insurance product because it's like pennies on the dollar. Like, let's say you have a few million in the bank, okay? However, you're like 30 or 40 or 45. Yes, if you die, your family would be okay. But then that million or million and a half or 2 million, that would all be used for, living expenses, mortgage payments, et cetera, et cetera, et cetera. If term life insurance is like $50 or something, or $60, like, you might as well just spend it and, buy the term life insurance. As you get older, you can start to, weigh the pros and cons between like, okay, well, I'm now 55 or 60, term life insurance at this point is like hundreds and hundreds of dollars. Maybe it wouldn't be worth it in that case. And that's on a case by case basis. And then the other side to that, using permanent life insurance to transfer your wealth to the next generation, that is another effective way to use permanent life insurance just because of the tax advantages. So yes, absolutely, you can just pass those down to the next generation if that's what your planning entails. However, if you have some plans already to pass that down, you can easily just run the numbers and run the comparison. Like, all these different insurance companies have calculators built into their software to say, like, what's more valuable if you just leave this in the S&P 500, or if you buy permanent life insurance and you gift it to and it goes to your children as they're the beneficiaries. And like, they all have this software, and you can all just run the numbers and see which one's more beneficial and run it at 5% and 6% and 7%, do it with capital gains and do it with dividends and do it with interest. You can do all these things to figure out what would be worthwhile, pardon me. So it's like, you know what I mean? It's not all the time. You can't say that all the time.
Great discussion.
I thought whole life was going to be like timeshares, where it just kind of dies over time. But TikTok has caused a renaissance of whole life agents to start their financial planning influencer careers.
You're kidding.
I agree with that.
And so now,
so they're like whole life guys that are trying to make it cool again.
Well, they're peddling it with new
make
terms.
whole life cool again.
You've seen this: index universal life, infinite banking. Dave,
infinite banking. Yes. I actually I have a video on my channel if you're interested in it. Just look up infinite banking. I did a deep dive into infinite banking. I think you guys would really enjoy that video. Just look up infinite banking concept on my channel, or drop a comment and I'll send it to you.
Banking
this is
back?
The hack wealthy people don't want you to know.
Infinite banking
this is my
is
guy.
back? That was a scam from like 20 years ago.
Well, Gen Z is eating it up on the TikTok, Dave.
I say all this stuff.
Man.
It's
like
caused this resurgence.
Infinite banking is code for whole life that sucks bad. That's what it is.
Dave, come on, man.
Infinite banking is you put so much in the whole life that it starts to pay its own
and you
premium.
Borrow money from yourself, Dave. It's genius.
You borrow money from yourself, and guess what? There's no taxes on borrowed money. Well, no kidding, doofus. There's never been taxes on borrowed money.
Life
if you just
hack.
run over there and get you a credit card debt,
Oh my gosh.
there's no taxes on the debt, you dumb butt. Of course there's not.
Dave.
Oh my goodness.
I can't believe infinite banking is being made cool on TikTok.
Just ignore all
my
of
God.
that.
This Tic Tac thing is just driving me nuts.
Now it's Tic Tac, according to Dave. Well, hey,
I gave
here's
up.
the takeaway. Get term
God.
life, 10 to 12 times your annual income, 15 to 20 year
You know what?
policy.
If infinite
with our friends
banking
at
can
Xanadu.
make it on
my
Tic Tac,
God.
I bet I could make it on Tic Tac.
For sure you can. This clip is the start right here.
Oh, man.
All right, guys. I hope you guys enjoyed today's video. If you guys have any questions or comments, just drop them below. And if you guys enjoyed this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.